Single-family investments are the worst path you can take in real estate. Hear me out. Sure, buying a single-family home is better than not buying any real estate at all. In fact, I still feel that residential real estate is better than any other investment vehicle you can choose. But that's not what we're here to discuss today. I'm going to show you why you should be investing in commercial real estate instead of residential properties. I know, the cost of entry is lower on the residential side, and it's very attainable for most first-time investors. The process is also not very overwhelming for the most part. I mean, over 60% of Americans will own a home during their lifetime, so most of you will have experience with purchasing a home. You save up, you finally buy that dream home, and after years and years of living there, you buy a new home and rent the old one out. Residential real estate is really just a glorified bank account. Commercial real estate, on the other hand, offers investors a more diversified, balanced, and scalable approach to real estate investing. Building a portfolio of passive commercial real estate investments is, hands down, the path to take. And there are many different paths that you can take to becoming a passive real estate investor. So here are 5 reasons you should forget about residential investing. Higher quality tenants. I'd take on a business rather than an individual as a tenant every single time. Sure, you might be able to find high quality residential tenants for your single family investment, but they're still an individual. Businesses can bring higher credit, often national or regional, and these leases will usually be backed by the company with a personal guarantee from the partner or partners in the business. You have a much stronger safety net there, and they are more likely to respect the property more. A business's location is often their image, especially if they're hosting clients at their space, so it's very important for them to maintain the quality of the real estate. Commercial real estate is also ungoverned by fair housing laws. When leasing residential real estate, you have to be very cautious not to violate any aspect of the Fair Housing Act. However, in commercial real estate, you can ask your tenants just about anything that you need in order to properly vet them for your space. You can request tax returns, personal financial statements, bank statements, profit and loss reports, balance sheets, maybe even their mother's blood type. The list is endless, and that's just the tip of the iceberg. If you're not thrilled by what you're seeing with that tenant, you can refuse to lease the space to them without having to worry about legal repercussions. You have fewer expenses as a landlord. It's very rare that your residential tenant will cover your property taxes, your building insurance, and the property maintenance. In commercial real estate, however, it's rather commonplace, depending on the type of property and the lease structure. Retail, along with some industrial and office properties, often had what's called a triple net lease. Check out this video here for more information on the triple net lease and why it is so great. And while many investors have a different definition of what triple net actually means, they are an extremely valuable asset for commercial real estate investors. In a triple net lease scenario, the property owner is not responsible for paying any expenses, such as the taxes, the insurance, utilities, etc. on the property. And if the lease is absolute net, the tenant will also take on 100% of the responsibility for maintaining the building structure, which includes the roof, foundation, plumbing, doesn't matter. Larger corporations, such as Starbucks, will sign this type of lease so that they can maintain their brand's look and feel without having to rely on the landlord to make those decisions, or not make them. Landlords will solely be responsible for paying their mortgage on the property. Talk about a win for the investor and mailbox money. Forced appreciation. One of the biggest differences between residential and commercial real estate is how property values are determined. Residential real estate is largely influenced by comparable properties. So your single family investment will only go up in value as long as properties in the immediate area sell for a higher price. And that can be a grind when residential appreciation is historically 3 to 5% per year. Commercial real estate, on the other hand, is directly valued on the property's revenue. Simply put, the higher the cash flow a commercial property generates, the higher the property's value will be. Because think about it, these are actually investments. They're not just somebody's home where you're willing to pay a retail price for. Investors will be willing to pay premiums for that cash flow. By curating the right tenants and leases, you can create stronger cash flow and higher values. Overall, better returns. Commercial real estate can be more on the risky side, and with greater risk comes greater reward. Compared to typical returns from residential investments, cash flow and appreciation are far more attractive in commercial real estate. There's just no arguing it. Businesses can afford to pay much higher rents than individuals can, and they'll also sign longer term leases, 2, 3, 4, 5, 10, sometimes 20 years. So less consistent turnover for commercial investors. The stock market offers an average annual return of around 10%, slightly below that expected of residential real estate. While real estate investment trusts, one of your options as a passive real estate investment, have averaged nearly 13% annual returns according to the MSCI US REIT Index. Longer leases. I mentioned this briefly, but residential lease terms tend to be in the 6 to 12 month range, while commercial leases can be 3, 5, or 10 plus years. As an investor, commercial property can give you lower turnover costs and vacancy rates. These long lease terms give you more reliable passive income and much less of a headache by not having to market a property year after year. Sure, it's also possible that you could end up with less than desirable tenants for an extended period of time, which nobody wants, but if you properly vet your incoming tenants with lease applications, financials, and background checks, you can avoid these long-term issues. Okay, so now that you know why you should be investing in commercial over residential real estate, check out this video here on how to build your passive income as an investor and why you should be doing that more, and I'll see you there.